What's up, guys? Raymond here with another financial statement analysis. This is going to be our ninth, I believe, in the series of German energy sector stocks. And in this video, we're going to be analyzing a stock called Varta. And without further ado, if you're new to my videos, by the way, in the financial statement analysis videos, we analyze, kind of indicative of the title, financial statements, the top three the top three relevant financial statements of a company, that being the cash flow statement, the income statement, and the balance sheet. And we look for key indicators that usually determine to a high degree the financial stability of a company, as well as the financial strength in the future, and how long how long the company will last, whether or not it has a strong long-term future or not. So without further ado, we're going to get into the info and stats, specifically the key ratios. The market cap of this company is 3.16 billion euros, which is good. We always look for companies with large market caps because that usually tells us how marketable and how attractive the stock is to investors. Also, given the market price fluctuations over time, adjusted, that can kind of give us an idea of how attractive the stock is to investors. So the PE ratio is 24, which is pretty good actually. We look for stocks that have usually a great PE ratio would be around 10. That is quite low, but 24 is not actually very bad, considering the market cap is over 1 billion euros. So the revenue figure is 902 million, just under 1 billion. Earnings per share is 3.13 euros. I'm going to check that according to the market price. So that is about, I believe, 8%, just under 5% earnings per share for that financial year, that being the last financial year. The dividend yield is 3.18%, which is not completely bad. We do look for dividend yields of around 5% minimum, but 3.18% is better than a lot of stocks, considering those stocks, well, usually largest cap stocks don't give out large dividends. Some of them don't give out dividends at all, but as of late, stocks have been giving out dividends due to pressure from investors. So even the largest cap stocks might give out a small dividend, maybe around 1% or less. So 3.1% isn't too bad. Let's look at the income statement. Actually, we're going to look into more ratios because this is something we haven't really done. The price changed, the change relative to the S&P 500, and the volume. So we're going to just quickly scan through this to see if there's any relevant information. So all of this is relevant to price fluctuations and beta, which isn't too important. The beta level is just the risk level slash volatility level. So the beta of this company is 0.97, which is 3% lower than the market average, which isn't too bad. Actually, it's not too bad. It's actually pretty good, considering that we're in a quite tough market situation right now. So the income statement shows the profitability of a company, the net income specifically. So as you can see, the revenue has increased progressively over the last 3 financial years, as well as the profit margin. There is quite a decent chunk of profit there for the past 3 financial years. 2019 was probably the worst of the years, but still it was doing pretty okay with regards to profitability. The next year was also pretty good, but could be doing better. The last financial year, the company reduced its revenue, but increased its profit margin, so it became more efficient. It became better at profiting from sales, which is pretty good. I'm guessing they changed their sales structure. So we're going to go into the balance sheet. The balance sheet shows the leverage, how leveraged the company is with regards to borrowed money and general liabilities, compared to the value of the assets the company has, that being cash and capital. And so we're going to look at the past 3 financial years, and we can see the trend of assets going up gradually, well, not gradually, actually quite progressively and quite rapidly, as well as the debt. But the debt figure does remain around the same, at around 55% of assets. So that is not too bad actually, considering a lot of companies are quite over leveraged, especially in the energy sector. So the energy sector, the banking sector, general financial sector, companies tend to be very over leveraged. Not over leveraged, but it depends how you define the term. But they tend to have a lot of debt compared to assets, which does a great job of deterring investors, specifically because investors are looking for profit in terms of dividends or capital gains. And if the company has a lot of liabilities, specifically debt, the company owes a lot of interest. That just takes away from the cash flow, and that takes away from the investor's pocket. So that is a deterrent. So we're going to look at the last financial statement in a bit more depth, which is the cash flow statement. So the cash flow statement is the last part of the story of the financial life of a company for that specific financial year, and it's broken down into three parts. The cash from operating activities is the first part. Second part is the cash from investing activities, and the last part is the cash from financing activities. So we're going to look at the first part, the cash flow from operating activities, and just as a precursor, the starting line is the net income. So the net income from the income statement, the profit margin, is what we're going to be starting off with, and we're going to see how that net income has changed with regards to the end or the last line of the cash flow statement, which is the net change in cash. So we're going to go straight to net change in cash, which shows that the balance is negative 48 million. So we're going to see how it got from, the company went from 177 million euros to negative 48 million euros. We're going to look for the largest outliers. So the company paid off a lot of debt, 66 million euros worth of debt. So that's taken away some of the cash that the company had from profit. Financing cash flows, the company gained 81 million from financing. So investing cash flows. Capital expenditure, so the company spent a very large amount of money, almost all of its profit, on capital expenditures. So that being increasing the property, plant and equipment, so making the company larger in terms of capital, and hopefully within the next financial year their operating income could be larger, simply because they have more capital to do more work and to bring in more revenues. With regards to profitability, if they maintain the same structure or maintain the same progression as they've done between the 2020 financial year and 2019 financial year, then we should see an increase in profitability as well. So yeah, that is definitely a positive indicator. I definitely would like to know more with regards to what specific capital expenditures they spent the 174 million euros on, but I believe that can be found in the more in-depth financial statements, probably on their website. But we're going to go more into the operating activities. So the company has gained 114 million from operating activities, and that should overall take the company's cash to around 290 million. But as you saw earlier, the company spent a lot on buying capital, plant and equipment, and also investing activities. And the company also paid out a lot of money to retire debt. So that's pretty much where most of the money, well, more than all of the money, had gone. And that is why we end up with a negative balance of 48.78 million euros. Without further ado, I'm going to close this video. I hope you guys have enjoyed it, and I will see you in the next one. Peace.